Alright, so hi guys, in this video I'll be showing you how you can roll a cash secured put position if for some reason you do not want to be assigned the stop if the share price goes way below the strike price of your cash secured put. So the best way to show you is to actually use a backtesting tool with Think or Swim. So I'm going to go to on demand, right, on the top right, which is the backtesting tool. And with on demand, I can actually go back to any point in time, like Back to the Future, go back in time to any point of time to execute the trade and show you how it plays out. Okay, so I'm going to look at Lockheed Martin for a reason. Is because you can see there's a big plunge during the COVID-19 crash, and then it kept going down. So I want to show you what you could have done if, for example, you sold a cash secured put before the plunge. So usually, as you know, we sell cash secured puts only on fundamentally good companies, companies that we know will always go up eventually, and companies that are undervalued. Now, if you don't know how to select a fundamentally good company that's undervalued, please don't sell cash secured puts. All right, you got to know what's a great company undervalued. All right, so let's just imagine that at this point over here, you see these wave patterns, right? Wave up, wave down, wave up, wave down, wave up, wave down. And again, the other thing is we want to sell a cash secured put only after a wave down, after a drop. All right. So at this point of time, let me just zoom back to this event here. Okay. Now, obviously, let me just go back another day. Okay, there we go. So obviously on this day, it was the, let's see, 26th of February last year. And you have no idea it's going to plunge. You're thinking, okay, this looks like a support level. So I think it's going to, bounce back up. So I'm going to sell a cash secured put to get some premium. And if it goes below the strike price of the put, I could get assigned the shares. I don't mind buying the shares as well, right? So that's the reason we sell a cash secured put, collect premium. We don't mind being assigned the shares. So let's imagine that on this day, you decide to sell a cash secured put below the current price. So normally we sell a cash secured put at, we could choose like 30 delta, for example, right? 30 delta could be a good level, or we could sell the put somewhere at this level as well. All right, so let's open up the charts. And again, this is actually, we're actually going back in time. So this is, let's see, what's the date here? 26th of February, all right? So I'm going to go back to 26th of February 2020. Let's go back in time with our time machine, all right? So there we are, 26th of February. Make sure the time is when the markets open, all right? Now, by the way, this is my local time. This is a local time, which is 11 p.m. Singapore time, which is 11 a.m. New York time, right? So it's got to be when the market opens, all right? So it's now going back to history, all right? So there we are. Now we are back in time. We are at the 26th of February, and right now Lockheed Martin is there. So I'm going to sell a put option. So I'm going to click on trade, and usually we will choose about 35 to 45 days, right? So the closest would be choosing maybe this one, 3rd of April expiry. Okay, that'll be the closest to 35 to 45 days, right? So 3rd of April expiry, and we're gonna sell a put at about 30 delta, all right? So we could choose this one, 390. We sell the 390 put. So that means basically we're selling a put at 390 here. Okay, I'm just gonna roughly put a marker, right? I'm gonna put a red marker to signify that that is the strike price of my put. So if I sell this put at 390, I collect about $7.45 in premiums, right? $7.45, $7.45 per share in premium. And once I collect the premium, I'm obligated to buy the shares at the strike price if I'm assigned the shares at expiration in 37 days. So I'm gonna do that right now. I'm gonna click this, and I'm gonna sell at 7.45. Okay, so 745, and I'm going to confirm and send. Again, I collect $745 in premium once I sell the put. Okay. Okay, so the order just got filled. Again, this is a virtual backtesting platform, right? So just sold that put for 745. Now, bear in mind that when you open this virtual platform, they give you $100,000 of money. All right, so you can see that right now my $100,000, I'm credited with the 745 premium. So now I've got $100,745 in cash. All right, so let's go back to the charts. Okay, so again, I sold this put at 390, and it's going to expire. You can see right now the order is there, right? It's going to expire on the 3rd of April. So now what I'm going to do is I'm going to fast forward to the 3rd of April. The date is going to expire, all right? So I'm going to fast forward to the 3rd of April. Let's go to our time machine again. We go to the 3rd of April. Okay, 3rd of April there. It's a Friday, and we're going to go. So you can see that on the 3rd of April, which is here, the price would have plunged down and ended up here. All right, so what happened to our put on the 3rd of April, just before expiry? Let's see what has happened to our put. So you can see that now the put we sold is in the money, and it's got a negative 2815, right? Obviously, because the share price has gone below the strike price, it is now making a loss. And you can see my net liquidation from 100,000 is now $97,185. So what could I do? Well, what I could do is I could just let the put be exercised, right? So if the put is exercised, what happens is that I'll be obligated to buy 100 shares of Lockheed Martin at 390. I'll buy 100 shares at 390, and at the same time, I get to keep the 745 premium. Now, I could do that. Now, but if for some reason I think to myself, you know what, I don't want the shares anymore, right? If I don't want to be assigned the shares for whatever reason, okay, I'm going to show you now how you could roll the put. So rolling a put basically means that you close the put. It means you buy the put back for a loss, but then you simultaneously sell another put, so you collect more premium or new premium to offset the loss of the old put. That's called rolling. So I'm going to show you how it is done right now with this simulated environment. Okay, so bear in mind that how much have I lost on this put? So I sold the put at 745, and right now, if I want to buy the put back, I have to buy it back for 35.60. Can you see that? So what's my loss per share? My loss would be 745 minus 35.60. So I would be losing $28.15 if I choose to buy the put back and close the position and not be obligated to receive the 100 shares. So that's what I'm going to do for demonstration purposes, right? So I'm going to close this put right now, highlight this put, okay, and right click. So I'm going to buy back the put, right? So I'm going to buy the put back at the market price, which is 38.50. Confirm and send. Done, right? So I've bought the put back. So now I've bought the put back. What happened? I realized the loss. So you can see my account from 100,000 is down to 97,000. Ouch, right? Okay, but so I've lost $28 per share. So what I'm going to do right now is I'm going to simultaneously sell a new put to collect new premium that's going to offset the loss of that first put I had to buy back. So right now I'm going to sell a new put. Okay, so right now where is the stock? Right now the stock is here. Okay, so I'm going to sell a new put, and I just have to ensure that when I sell the new put, the premium I get should be more than what I lost. Okay, and ideally the strike price that I choose should be lower than the initial strike price. Remember, my initial strike price for the first put was 390. So I want to, if I could, right, lower the strike price, get more credit, and buy myself more time. So let me go back to the option chain. So I'm gonna by default again go to 35 to 45 days. So let's go to 42 days here. Again, there's no right or wrong. You could choose 35 if you want to, but let me just choose 42 days. So I gotta sell a put that's gonna make back at least that money, right? So I'm looking at the market price to get at least get back 28 bucks. Okay, how about this guy? All right. So if I sell this put with a strike price of 370, right? 370 strike price, I'll collect 32.85. So this 32.85 I collect will be more than enough to cover the loss of this guy, right? So let me just write it down. 32.85, right? So if I sell this put, I can cover that. So I'll still have a net profit of, let's see, 32.85 minus 28.15, 470. So I'll still have a credit of, a net credit of 470, as long as it's a credit, right? You want to get a credit. Got it so far? All right. So I'm going to sell the 370 strike. Now, the 370 strike is lower than the initial 390 strike. Like I said, I ideally want to lower the strike. So I lower my break even in a way, and I buy myself 42 more days. Now, some of you may be asking, but Adam, this 370 you're selling, how about the delta? The delta is like 57 delta. Okay, don't worry about the delta, right? I only look at the delta for the first time I sell the put. Thereafter, screw the delta. Well, I do look at it, but it's not that important, right? What's more important is that I get enough premium to cover the loss, and I lower the strike. That's the most important thing, all right? Okay so far? Okay. So I'm going to sell this 370 right now at 32.85. So click on that. 32.85. And sell it. And this will expire 15 May, right? So send in. Sold. All right. I've sold this put. Collected $32.85. So my cash is back to 100,000. All right. But although my cash is back, you can see my net liquidation is still at a loss, obviously. Okay. Okay, so let's go to the charts right now, and you can see that from 390, I have now lowered the strike to 370. So that's my new strike. $370. So by the 15th of May, in 42 days, if the price stays below 370, then again, I may still be assigned the shares, right? But if it gets back above 370, then the put will expire worthless. So let's see what happens. Let's go to the future now, all right? So just bear in mind, I've got a credit of 470. Let me write this down. I so far have a credit of 470. 470 credit, okay? Okay, so let's go to the future. Let's go to the 15th of May, which is the expiry of the new put I sold. So 15th of May, let's go to the future. 15th of May, go. Let's see where it is on the 15th of May. Okay, so there we are, 15th of May. Now we are the 15th of May. The price is still below the strike price, which means that if I don't do anything, this second put I sold would also be exercised, and I'll be assigned 100 shares at 370, which is not as bad, right? Because the first time I'll be forced to buy the shares at 390, but now I'm forced to buy the shares at 370. So in a way, I'm paying a lower price. Plus, I get to keep this second premium as well, all right? But again, if I don't want to own the shares for whatever reason, I want to roll the put again. I'm going to roll it a third time, okay? So now, if I want to roll the put, again, I have to buy this second put back. So this second put I sold, remember I sold at 32.85, right? And now, if I want to buy it back, I got to buy it back at 12.75. which means do I make a profit now? Yes, I make a profit of $2,000. All right, so for those of you who are a bit confused, let me pull up an Excel spreadsheet to show you basically what we've done so far. Okay, so let's summarize. So the first thing we did was we started off by selling that first put at 390 strike, and we sold it and collected 745, right? And then we bought that put back at 35.60. So minus means we pay back, plus means we receive money. So for the first transaction, recall we lost 28.15. And then we sold a new put at 32.85 in order to cover the loss of that first trade. So 32.85, covering the loss would still be a 470 credit, right? But now we have to buy this guy back as well because this did not expire worthless. So if I want to buy this guy back, I have to buy this 370 back. How much will it cost me? Right, let's look at the chart right now. It's going to cost me $12. Now it was $12.75 earlier, but you can see it's now dropping, right? Again, this is like a real-time thing. So I want to buy it back now at $12. So let's buy it back at $12. Okay, so highlight, buy it back at $12. I'm going to buy the put back at $12 before expiry today. So buy it back. Okay, close the trade. Great. So I've closed the trade, bought it back at $12. So essentially what has happened now, I bought this at $12, so I have to pay $12, right? So right now, what is my net profit or loss? It will be minus 28.15, and then this, and this, boom. So now my net loss is $7.30. All right, $7.30. That's my net loss on this trade right now. So it is still a loss, right? So what I'm going to do now is I'm going to sell another put to get more premium to cover this loss. But the good news is, notice my loss is reducing, right? Initially my loss was $28. Then now my loss becomes $7. So as I keep rolling it, my loss will reduce until eventually it'll become a profit. Now, this is if I don't want to own the shares. If I want to own the shares, I'll just get assigned the shares and I don't have to buy the put back. This is for some reason if you don't want to own the shares, for whatever reason, right? And you just want to keep rolling the put till you don't have to own the shares anymore, right? I'm just showing you another alternative. Got it so far? Okay. Now, maybe another way I can show this would be, yeah, okay, fine. So let me just put $sign so it's a bit clearer. Okay. So we are now down $7.30 on this, okay? Now, another way to calculate could also be to say, hey, you know, this transaction, I lost 28.15, right? This minus this, but this I made 20.85. So my net, if I put a net profit here, maybe this could be clearer to you guys. My net profit would be minus this plus this. I'm down 730. Okay, great. So now I need to sell another put to cover the net loss right now if I don't want to be assigned the shares. All right, so based on our simulator, it's a Friday, so and it's gonna close. So let's sell a new put on Monday, right? So we're gonna go to Monday, the 18th, and it's a new day, right? So it's buffering. So 18th would be right now here. Okay, so I'm gonna sell a new put right now, and I'm gonna sell a new put that will cover this 730 loss that I have. Let's go to trade, and again I could choose 39 days, which is closest to 40 days, right? And I'm gonna sell a put that's gonna be covering the $7 loss, right? So which one has at least $7? This one, right? 350 put, 855, right? I could sell the 355, 360. So let's sell the 350. So if I sell the now bear in mind, right now Lockheed is at 375, right? So if I sell the 350, delta's at 28. So I could choose another 34 delta. Let's choose this one. Let's choose the This one. All right. Let's go sell the 360 and the market price 930. And let's sell this. This expires on the 26th of June. Okay, so sold this at $9.30. So which means that now I've sold the 360 and collected $9.30. Which will cover this loss. But we then have to see whether we can get this to expire worthless, or we may have to buy it back, right? I don't know, right? Let's see how it goes. Okay, so this new put I sold, you can see, sold at 9:30 and expires on the 26th of June in 40 days. So let's go to the future to the 26th of June. 26th of June, there. All right, let's go. Let's see where we are on the 26th of June. Okay, so 26th of June, crap, it went down again, all right? Went down again. So now, this one that I sold, you can see it's now 10.15, which now means, oops, sorry, it went down to 185, sorry. Yeah, there we are, all right? So this put I sold at 370, sorry, 360, my bad, I got mixed up, right? So my strike price is 360 now, so 360. 360, there we are. That's the new strike price. So on the expiry date, you can see that it's right at the money, right? The strike price is 360 and the stop price is 360, so it's at the money. And so I could close it, right? Because if I don't close it, it could still be a sign. And again, if I don't want the shares, I just better close it. So if I close this trade, I will have to close it at 167. So I sold it at 9:30. I close it at 167. Let me close it at 167. Oh, now it's 215. Okay. May have to close it at 215. Okay, so close it at 168, right? Close at 168. You can see that. And so now I close it at 168. I bought it back 168. So now what's my net profit? So on this one I made 762, right? So I lost 28 bucks here. I made 20 bucks here. I made 7 bucks. So my net profit now would be 32 cents, $32, right? Okay, so you can see my cash is now $100,032, right? 32 cents, right? And my net liquidation is the same as well. Okay, so what's the purpose of showing you this entire exercise? The purpose is to show you that if you sell a cash secured put, and again, remember that we originally sold it somewhere here, right? We sold that put here. If you sell a cash secured put, usually you want to get assigned the shares, okay? And you don't want to buy the put back. But if for some reason you don't want the shares anymore, I'm showing you now an alternative where you could actually roll the put, keep rolling the put, until you don't lose money on the put anymore and you don't have to own the shares anymore, right? And what we did was we kept rolling the put, giving time for the stock price to recover. Again, the most important thing is that you should only sell cash secured puts on fundamentally good companies that you know will go up in the long run. So what's a fundamentally good company? It's a company with a wide economic moat. It's a company with consistent growth in sales, profits, and cash flow. It's a company with low debt. That's a fundamentally good company. Again, learn more in the value momentum investing course. Next, when you sell a cash secured put in the first place, it should already be undervalued. Okay, but we know that because of this COVID crash, sometimes undervalued can become even more undervalued. And for some reason, if you say, I don't want the shares anymore, okay, there is an alternative to keep rolling the put, and give time for the share price to recover. So in the end, you don't lose money on the put and you don't need to buy the shares. Hope this has been useful, and you got questions, all right, do share it in the chat group.